Hi and welcome to Swissquote's Daily Market Talk. It's Friday, October 10th. It's been a week and a half that the US government remains shut and doesn't release economic data, but mega deals in technology actually kept investors happy and busy throughout this week. In the FX markets, the US dollar rebounded despite the US government shutdown because politics elsewhere didn't look better than in the United States, while gold and oil are softer this morning on peace prospects in Gaza. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. What a week it has been, right? We didn't have time to get bored due to lack of economic data from the US. We had mega deals on the wire announced every other day in the technology sector, instead including Nvidia and AMD's big deal that sent AMD shares and other technology players' stock prices straight up on Monday already. Then a few hours later than that, XAI announced that it has actually secured a 20 billion US dollar funding from companies including Nvidia itself. Then SoftBank bought the Swiss ABB's robotics division this week, sending its own share price to the highest levels on record and by far. And they also announced just this morning that they're in talks on a 5 billion US dollar margin loan backed by ARM to fund OpenAI. Then Dell doubled the sales and profit estimates earlier this week, saying that they got their AI demand projection wrong last year. That is in fact way stronger than they imagined. And JP Morgan's Jamie Dimon backed appetite for AI as well. Meanwhile, the AI bubble discussions remain on the headlines, obviously, because some investors think that this is the version 2.0 of the internet bubble of 2000s and it will burst at some point in time and leave a lot of financial damage behind. Some other investors actually think that this is a bubble. This might be a bubble, but it has room to grow bigger. And others actually think that this is not a bubble if earnings growth remains robust. And that's what's expected to be happening. That's what expected to be revealed in the coming earnings season in the coming weeks. The S&P 500's technology stocks, technology companies are expected to print a 21% growth, with Nvidia, for example, expected to make a 54 billion US dollar revenue without even counting China in. So in terms of valuations, Bloomberg's Magnificent Seven's P ratio stands near 39 level today. It is high, but it's not shockingly high either, and earnings should meet and exceed expectations. That's the major expectation for the coming earnings season. So the ball is in the earnings camp from now on, but early reports actually hint that the results could be strong. One Nvidia partner, Hon Hai, for example, reported an 11% growth in their quarterly sales earlier this week, and TSMC, another Nvidia partner, reported a 30% increase in their third quarter sales. And speaking broadly of earnings, the first batch of earnings announced yesterday came in rather on the optimistic side of the game. PepsiCo and Delta both topped expectations with solid earnings and upbeat outlooks, while Levy's beat on revenue and profit, but the company actually disappointed with a softer full-year guidance. But looking overall, nothing was alarming yesterday in the first batch of earnings, and more is to come in the coming weeks. We cannot wait. On the economic data front, however, well, we don't get the US official data because the US government remains shut, but the New York Fed's latest report on inflation expectations wasn't much enchanting for the Fed doves yesterday. Both 1 and 5 year expectations rose to and above the 3% level. Then the FOMC minutes that were released earlier this week hinted at more rate cuts in the US, but Fed members there are kind of obliged to take the inflation risk into account. So the good news here is there is a nearly 95% chance assessed to another Fed rate cut by the end of this month. The bad news is that the economic data should be justifying these rate cuts, and in the lack of economic data, well, the Federal Reserve expectations don't necessarily get gently readjusted toward where they should be, which means that when the US government reopens and the data comes in, the outlook could change sharply. So the risk to dovish Fed expectations remain, in my opinion, and the latter could fuel the 2-year yield and further support the latest rebound that we have been seeing in the US dollar. Speaking of which, the US dollar index will rally this week to the highest level since August, and that despite the US government shutdown that was supposed to weigh on dollar appetite. And that's because, well, there was a notable weakness in the euro and in the Japanese yen, as political news there weighed heavier than the US government shutdown news that were basically mostly priced in probably. So speaking of those, the political impasse in France sure played a big role in sending the euro dollar below the 116 level this week, but the news of surprise fall in German exports further backed bearish conviction among the euro dollar traders, while in the Japanese yen, the short yen trade returned since Monday this week on expectation that the upcoming Japanese PM Takaichi will be pushing for easy fiscal and monetary policies, and the latter should weaken the Japanese yen, though I think, as many out there think, that this is far from being a won battle due to the fact that the Bank of Japan is now normalizing its monetary policy, that the inflation in Japan is rising, and the Japanese debt and yields are just too high to implement a Abenomics type of policies. But we will see. Still, the dollar yen is testing the 153 offers to the upside this morning, and there is now a growing chance of a further rise in the dollar yen into the 155-160 trading range. Elsewhere, the Reserve Bank of New Zealand cut its interest rates by 50 basis points this week, and the Kiwi dollar fell to the lowest level since April on the back of this dovish move as such. And as I was saying, after the FOMC meeting last month, that the US dollar was facing a hawkish readjustment, and this is what's happening right now. There are two risks to that bullish view for the short run, however, and that's the US government shutdown story that could weigh heavier on sentiment as the lack of data reduces visibility, and the trade war. And the trade war because there are news on the wire this week that the Chinese, for example, stopped buying soybean from the US producers, and that they are now curbing their rare earth metal exports toward the United States to gain leverage into the next US-China trade discussions, trade summit. So the latter actually keeps VanEck's rare earth and strategic metals ETF well supported, as US metal companies also benefit from political support, like Trilogy Metals, for example, that jumped more than 200% on Tuesday this week on news that the government would help. And on the geopolitical front, ceasefire news from Gaza helps keep US crude below the $62 per barrel level this week, while gold is below the 4,000 level per ounce, and silver is back below the $50 psychological level after briefly trading above the $51 level this week. The dollar's rebound and easing Middle East tensions could encourage a minor correction in precious metals, but the medium-term outlook for these precious metals remain positive, and especially for gold, on reduced appetite for traditional currencies combined with strong central bank buying and rising inflation risk globally. Now, one last thought before we go. For those who are actually worried that the S&P 500 is too highly priced right now, well, its price in terms of gold hasn't been as impressive, mind you, because the S&P 500 actually lost 70% of its value since 2000's peak in terms of gold. In fact, buying and holding gold over the past 25 years would have actually paid you off better than buying and holding the S&P 500 index. But gold also experienced significant price pullbacks, remember, and we could just be about to see one coming in the next weeks. Would that derail the actual enthusiasm around gold? It is yet to be seen. Many fund managers think that keeping 10 to 15% of a portfolio in gold is still, and it has always been, a good idea. So this is all for this week. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. It's very important for us. So I will be off for next week, mind you, so I will be meeting you again in a week, Monday in 2 weeks. So until then, take care and I will see you soon.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.